Commercial banking is a $1.2 trillion market, which makes it the fourth biggest industry in the US. And I'm sure I don't need to tell you about the importance of banks to us and the global economy, mainly as a safe storage for our hard-earned money. However, the failure of Silicon Valley Bank, Silvergate, and the takeover of Credit Suisse represent not only a disruption to this trillion-dollar market, but also a crisis of confidence among the people as they line up outside the bank, waiting anxiously wondering whether they will lose their life savings, a scene that don't happen that often, especially in the 21st century. So, what do all of these bank runs and failures really mean? Will we see another repeat of the dreaded 2008 global financial crisis? And what are the similarities and differences between today's bank failures and that of 2008? Okay, so as of recording, the two bank failures that have happened are Silicon Valley Bank and Silvergate Bank. Credit Suisse and First Republic got rescued, so we can't count them as failures. At first, they all appear to be separate cases, but the cause of their collapse is actually the same. They are all failures in risk management. For example, 89% of SVB's funding came from deposits, which is an insane amount even for a bank. And their depositors are mostly startups that are all in the phase of burning money. Having such a risky customer base meant that the bank's growth mirrored that of the startup industry. As the economy contracts and VC investors pump less and less money into startups, well, these startups then try to pull their money out of SVB, and long story short, it failed. With Silvergate, it's the exact same thing. Only this time, their customers aren't startups, but crypto companies like FTX and Alameda. As all of their customers are heavily exposed to crypto, it grew and declined along with the crypto industry, especially as crypto investors began losing their faith with the collapse of FTX and the crypto crash, causing a massive contagion effect on Silvergate. Credit Suisse, while they do have a diversified customer base and a strong balance sheet, has suffered massive reputation damage for the last 5 years or so thanks to numerous amount of scandals, like spying on an employee, a massive data leak of its clients, to being accused of money laundering for a Bulgarian trafficking gang. These scandals drove away many talented staffs and rich clients alike, resulting in a massive hit on its profitability. If you notice, the 2008 GFC was also caused by failures in risk management, as banks held on to their billions of dollars worth of AAA rated mortgage-backed securities, only to find those billion-dollar securities to be totally worthless as the housing bubble collapsed. But there's also another major macroeconomic similarity that is kinda obvious but most people don't realize. Today, we are in the same credit cycle as in 2008. Okay, so what does this mean? Well, we can divide the movement of credit and interest rates into 4 broad phases. The first phase of a credit cycle is the expansion, which typically begins after a period of crisis. In a period of economic expansion, interest rates are low so that money is cheap to borrow, and businesses started building up their inventories again in addition to hiring more people. As a result, unemployment declines, consumer spending increases, GDP rises, and asset prices like stocks, bonds, and housing all perform well. In short, in a period of economic expansion, everybody's happy. But too much happiness leads to trouble, and this will lead to irrational exuberance where people became so enthusiastic seeing their investment increases massively in value, like what we saw in the early 1990s and the 2000s with the dot-com bubble and the housing bubble leading to 2008. As a result, the price of assets increases beyond what the fundamental of those underlying assets justifies, leading to an asset price boom. This is where we enter the second phase of the credit cycle, the peak. Economic growth hit its maximum rate, demand for goods has risen so much to the point that businesses do not have the capacity to meet those demands, and asset prices get out of hand. But as asset prices went out of control, the central bank will then become worried about inflation as the economy overheats. So they will start to raise interest rates, albeit slowly, as the economy still hasn't shown signs of slowing. Now, one major problem with Fed raising interest rates is what policymakers call a rate hike lag. Basically, there's a time lag existing between when the Fed increases interest rates and when the effect of that interest rate hike are felt in the economy. Because of this, the Fed will keep rising interest rates all the way through a credit cycle, as the data will sometimes not reflect reality. As a result, the economy will begin to decline and we enter the third phase of the credit cycle, the fall. Now, in the early stage of the fall, we actually will see increases in borrowing. For example, this recent publication by the FDIC shows that from 2022 to 2023, total loan balances increased 8.7%, commercial and industrial loans increased 9.7%, residential mortgages increased 9.8%, and consumer loans increased 10%. The increase in loan balances this year was the second largest in the history of the quarterly banking reports by the FDIC, dating back to 1984. That's 39 years worth of data. You might think that this is weird, since in an era of rising interest rates, borrowing becomes more expensive. So why do people borrow more? Well, the economic slowdown will actually cause consumers to borrow more initially as they make up for their lost income. And businesses will also borrow more to pay for their more expensive inventory, thanks to inflation. But in this stage, banks will also tighten lending standards as they are concerned that the interest rate hikes could boost the number of bad loans on their books. Banks that fail to do this or have really bad risk management like SVB and Silvergate will fail. In case you haven't noticed, this is where we are today, and this is also the exact stage we're at in 2008. As banks tighten the flow of credit, the profitability of those banks will drop, the economy slows down, and usually, a recession will ensue. This leads us to the fourth phase of the credit cycle. The Fed will decrease interest rates to boost the economy expands, and we go back to cycle 1. Okay, so since we're at the same stage as we were in 2008, does this mean that we will experience another 2008? Well, actually no. And to understand why, we need to examine the types of assets that banks held. In 2008, banks held trillions of dollars worth of mortgage-backed securities, including subprime mortgages. Everyone believed that these securities are good investments, and many financial institutions had taken debt by providing loans to subprime borrowers. Now, I don't want to go too much into detail since that could be another video on its own, but long story short, banks and shadow banks alike taking unnecessary risks and pinning their hope on a housing bubble meant that all things collapsed when that bubble eventually burst. But today's bank failures had much to do with the bond market instead of the housing market. The global bond market is a $119 trillion market, with 46 trillion of it concentrated in the US. A lot of these bonds are held by banks. Every bank holds different amount of bonds, but roughly, they hold at least 5 to 20% of bonds compared to their entire assets. However, as central banks around the world started worrying about inflation and rising rates abruptly, from 0 to 5% in the US for example, the global bond market experienced a severe downturn where $15 trillion worth of wealth are wiped out in a matter of months. A lot of these bonds are owned by banks, which is one of the reasons many banks are tightening their lending standards today. And banks that simply don't have the risk capacity will fail. But these losses are mostly in government bonds, which is a temporary fall. This is very different than in 2008 when banks held most of their assets in worthless mortgages. And banks are much safer today compared to 2008 as they held a lot of reserves compared to their loan losses, thanks to Basel III. So most banks that do have proper risk management, with diversified assets and customer base, will likely survive amidst this downturn. Of course, there are exceptions. For example, SVB owned about $120 billion in long-term bonds that were extremely safe, but they failed nonetheless because they didn't hedge the interest rate risk on those bonds. The reason why they didn't hedge is pretty much debatable, but as the Fed raises interest rates, that $120 billion bonds plummeted in value, and they didn't have any other assets that could help to hedge the losses. Without any sort of hedge, SVB essentially bets that interest rates will stay low forever, which is a rookie mistake. Now, as we're talking about Silicon Valley Bank that depends heavily on the rise of Silicon Valley startups, do watch this video if you want to know how Silicon Valley actually begins, and how these 8 men sparked the venture capital industry to be as big as it is today. This is Doverhill, and see you next time.